ownership claim. That's where the money came from. What did the company do with it? The answer might be, we still have $1 million in cash, and we used the other $3 million to buy a long-term asset, an office building. The right side of the balance sheet, the liability side, tells us where the company got the money. The left side, the asset side, tells us where it went. Every dollar that came into the company went somewhere, so the two sides of the balance sheet have the same bottom line. They balance. You need to realize that constructing a balance sheet requires making several assumptions. After all, the idea is to capture the essence of a huge company and distill it into information on a few pieces of paper, or today, a small computer file. Let's be blunt. That's an impossible task. You have to make simplifying assumptions, and you have to realize that the result is an estimate of reality, a guess, and not reality itself. That doesn't mean that the exercise of making financial statements is useless. Far from it. Financial statements can teach us a tremendous amount about a company. As with anything else, though, we can't expect them to provide more than is humanly possible. Let's look at some common entries on a balance sheet. You won't find all of the ones we'll discuss, and you'll find a whole lot that we won't discuss at all, especially for bigger companies. Even a relatively simple balance sheet takes 2 pages, and you're not going to earn a degree in finance and accounting from this lesson. Instead, we'll focus on a few key concepts so that we can understand the language that financial accountants use. The good news is that for the most part, accountants, financial economists, and other market participants didn't sit down to develop the language of finance and accounting. The language evolved, just like any other language. For example, what would people having a conversation call the cash that a corporation holds? They'd call it cash, and so would everybody else, because everybody understands what cash means. Sometimes the names aren't so obvious, but understanding a few concepts and applying a little common sense can help us get a feel for what the balance sheet is trying to tell us. For example, lots of times a balance sheet will have an entry like cash and equivalents and another called short-term investments. You may not know exactly what those equivalents are, but they have to be something that the company can convert to cash immediately, even faster than a short-term investment. Those equivalents have to be something easily marketable, like treasury bills or maybe government bonds near maturity. You'd be right. The short-term investments would have to be a little less liquid than cash and equivalents, so we can guess that they're probably things like bank CDs. You'd be right again. The cutoff for short-term investments is 1 year. Anything lasting longer than that isn't short-term to an accountant. You know what inventories are, don't you? A company's inventory comprises the products on the shelf, goods in storage, and the like. For a company like AMD, which is a microprocessor company, the figure next to inventories would be the total value of the chipsets and other items that AMD has built but hasn't sold yet. Inventories can vary a lot during the year. Toy companies like Mattel tend to build lots of inventory before the Christmas and holiday season because so much of their sales are seasonal gifts. After Christmas, that inventory shrinks. It's a perfectly normal sales and inventory cycle. No company likes to have a lot of funds tied up in inventory because those funds aren't earning anything. Sure, you have to have inventory, but all else equal, I'd like to build a product on the exact day that a customer wants it. That way, I don't need to tie up money in inventory. That's impossible, of course. Inventory is a necessary evil for just about every company. For some, though, it's worse than for others. For example, if AMD has a lot of inventory, then that's really dangerous because the price of computer components tends to fall fairly quickly. $1 million worth of processors today might be worth half of that in just 6 months. That won't happen if Royal Dutch Shell has lots of unsold gasoline in inventory. Gasoline prices are as likely to go up as they are to go down. That's not so bad. If a company decides that some of its inventory has been damaged,